This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engines so that more folks can also discover and engage with all things microcap stocks. Next up on your microcap investing conference calendar, the Planet MicroCap Showcase Vancouver, in association with Small Cap Discoveries, is happening September 25 and 26, 2024 at the Fairmont Waterfront, Vancouver. We have announced the presenting companies, speakers, and sponsors that will be in attendance. We got Paul Andriola, Brent Todd, Jesse Gamble, Matthew Martin, and more ready to share their latest insights and what I'd arguably say is one of the best lineups ever put together for a microcap investor conference. Don't wait. You can register to attend at planetmicrocapshowcase.com. See you in Vancouver. My guest on the show today is James Emanuel, author of Fabric of Success and managing partner at Rock & Turner Investment Company. Quick synopsis of James's book. Most businesses are mediocre at best, but a small percentage stand out as exceptional. One thing that distinguishes one type from the other, the management. Oh, we've only talked about that like once or twice on the show. Fabric of Success unravels the golden threads that run through all businesses like Apple, Southwest Airlines, and more. In our conversation, James and I discussed these golden threads, how Fabric of Success is different from similar books like Intelligent Fanatics or Outsiders, and information that was a surprise for him when doing his research. Fabric of Success is available for purchase on Amazon, and I'll provide a link in the show notes. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my conversation with James Emanuel. James, thank you for joining me today. How you doing, man?
I'm really good. Thanks for having me.
Absolutely. It's great to have you. And thank you for, I know you're based in London, so I appreciate you making the time difference and all that jazz and joining us here today. And so, look, the main reason I invited you on here is that you just authored a brand new book called Fabric of Success. It just came out a couple weeks ago. It is available on Amazon as we speak. So for those that either after listening to this or just like the title name, you want to go buy it, by all means, or like Jen, whatever. But I wanted to have you on here to, one, get to know you, the author, as well as to discuss some of the key themes of the book, because it's very much in the vein of Outsiders, Intelligent Fanatics, which are all some of my favorite books of all time. So, any kind of book like that where folks can learn from some of the greats and you've been able to kind of figure out some core themes that made them the greats or great companies, I think that's all worthy of everybody should to read. So with that, before we get into the book and all that kind of stuff, love to get your background. How did you're also, like I said, managing partner at Rock & Turner Investment Company. So let's start there. What led you to where you're currently at today?
Okay, so I'll give you a bit of background, just quickly gloss over. I actually qualified as a lawyer, but decided not to practice. Instead, I went into finance and banking, and I've been in that industry for about 27 years. It was kind of a natural progression for me because I was always strong at maths and economics. And I actually come from a family in the finance industry. My father was a stockbroker, my brother's an actuary. So we're very kind of mathematical minded. So I kind of just fell into that vein. And in the course of my career, I've been involved in investing in a whole host of asset classes, fixed income, foreign exchange, commodities, and of course, equities. Equities are my real passion. And the fund that I run under Rock & Turner is 100% equity focused. So, during the course of that career, I've analyzed hundreds, if not thousands, of businesses. I've read books, I've read annual statements, I've engaged in conversations with CEOs, and by doing all of that, tend to learn an awful lot. And what really struck me is that of all of the companies that I've observed as being incredibly successful, there are these golden threads that run through all of them. And that was what inspired me to write the book. I wanted to pull out these golden threads and try and capture it in a book, and all of that knowledge that I've accumulated over the decades to try and share that with others.
Absolutely. And it's a big undertaking to really find and really notice some of those patterns as well. So, I mean, you kind of answered my next question about, what inspired you to write the book, but was there anything else? I mean, did you have a passion for writing? Did you used to write out theses for some of your, I mean, give me a little more.
Well, no, to be honest with you, going back to school days, I wasn't a natural writer. I was more a maths and science guy than an essay type subject guy. But as I said, I qualified as a lawyer, and lawyers are very much focused on words. So I've always had the ability to write legal texts or otherwise. So it was kind of a natural thing to pick up the book and to go with it. And once I got into the flow, it was relatively easy. This is actually my second book. The first book I published during the COVID lockdown. I hadn't intended to write a book, but of course everything was locked down. We were all stuck in our houses. We didn't have very much to do. And so it was something on my bucket list. So back then I wrote a book which was called Success in the Stock Market, which is also available on Amazon. It's been quite successful, but that is very different. That was focused on analyzing companies and how to value companies, and how all of the different valuation metrics link together. I've often found by reading investment analysis that a lot of people, even the professionals, don't seem to know how all the pieces fit together. And so I thought to myself back then, let's write a book and try and document that. I did it. It was my first book. I ticked that off my bucket list, but I enjoyed doing it so much that I applied my mind to, what other kind of book can I write? And that's where Fabric of Success came from.
Very cool. All right. So, as I said at the very beginning there, it's very much in the vein of Outsiders by William Thorndike, as well as the Intelligent Fanatics series by Ian Castle, Sean Iddings. I mean, there's been a number of books written talking about successful investments, successful investors, successful companies. I think there's even a couple that there might be even some overlap in a couple of those books. So I was just curious from the outset, what would you say differentiates Fabric of Success from some of these other books that are very similar?
Sure. Well, The Outsiders is one of my favorite books by William Thorndike. It's a fantastic book, and it focuses on 8 outsiders, 8 exceptional CEOs. Really enjoyed it, learned a lot from it. The Fabric of Success is slightly different. So although it focuses on ultra successful CEOs, it doesn't take them one at a time as the Outsiders does. Instead, it looks thematically at various things. So it looks at how recruitment perhaps ought to be done within a company, the structure of a company, avoiding bureaucracy, moving into a decentralized type of structure, how capital allocation should be done properly. And this isn't my opinion. These are things that I have learned from the way that others who have achieved great success have done it. And so what I've done is I've pulled quotes out of shareholder letters, out of biographies and autobiographies. And so the chapter on dividends, for instance, will have a whole host of quotes from, you may have Jeff Bezos in there, you may have Warren Buffett in there. But that chapter is solely focused on dividends. And then the next chapter might be focused on something different. And, there are about 50 chapters in total, which address every facet of running a public company, and while we're focused on that particular facet, we look at how all of these people, these successful people, dealt with that particular aspect of running their company, and then it becomes evident how similar the approaches are. And what struck me by writing the book is that what we have is entrepreneurs and businessmen and CEOs who span different generations, who are perhaps located in different geographies, and who are certainly active in different industries. And they all end up in following, almost converging on a very similar path. So they've almost found the successful recipe, and it's amazing how similar that recipe actually is.
Absolutely. And okay, so I totally and I apologize, I haven't read the book yet. I will definitely be picking it up after our interview today.
Please
because
do.
I because I really love how I like this idea of how you structured it where it's very different, right? Like on some of these other books, we're talking like, okay, Kelleher, Southwest. Why did this, and I'm not trying to make a joke or anything, but
Yeah.
that's how most of them are structured. Yours is basically saying, okay, HR or dividends, this, and then seeing how these successful CEOs tackled those issues and in order to make their company successful. I was curious just in doing your research of the book when again, I haven't read it yet, so I apologize, but did you do kind of top down or bottom up research when you came up with your thesis for what the thread is for success in each of those facets? Was it you did the research and then it's like, oh, all these CEOs are very similar in how they did this, and now here's my conclusion? Or are you saying, this is my actual thesis for how I think they did that, and then kind of found supporting research? Love to hear your thoughts.
Yeah, none of this is my thesis. Well, I was quite keen to keep my own opinions out of it because
Cool. Okay.
who am I? I've never run an Amazon or a Google or a super successful company. So why should anybody listen to me? In my opinion, they shouldn't. But of course, when it comes to recruitment, for instance, I mean, think about Steve Jobs. When he returned to Apple in 1998, one of the things he noticed was that John Scully was very much focused on cost, keeping costs under control. And one of the ways in which he did that was he effectively cut all of the very high paid, very skilled people that Apple had, and he had some very mediocre people who he could employ at a mediocre wage, let's say. And Steve Jobs came back and he noticed this, and in particular, he'd been involved with Pixar at that time, and one of the observations he made was that Pixar only had what he called A-list people, and A-list people produce A-grade results. And when he got back to Apple after Scully had been removed, the company was very close to insolvency. Apparently, they had 90 days of cash remaining. And he really had to change things up. And one of the things he noticed was that the company was full of mediocre people. And he slashed the headcount considerably. And he said, we're going to do things the way that Pixar have done it and the way I've observed things done at Pixar. And we're only going to bring in A-list people. And I've noticed by reading the biographies of others that they use exactly the same terminology. It's incredible. They talk about A-list people. Peter Thiel is a perfect example. He always talks about recruiting A-list people. And one of the warnings he had in his book, 0 to 1, was that as soon as you take on the first B-list person, those people try to make themselves look better, in his opinion, by recruiting C-list people. Because if you're a B-list person, you've got a lot of C-list people around you, all of a sudden you look good. But he says it becomes almost like a cancer. And so you don't want to dilute down the ability of your company by recruiting substandard people. You've got to cut that cancer out at the first opportunity, and you've got to have A-list people throughout the business. And so what I've done through this chapter is, I've pulled these quotes from all of these top CEOs, and to evidence how they've all converged on exactly the same conclusion. They've come from different places, but they've reached the same conclusion. And it will be silly of anybody now to ignore that. They ought to take it on board.
100%. So, that's actually a perfect example for the next question I wanted to get into and diving into the book a little bit more you can get as detailed as you want. That was a phenomenal example that I would love to read all the different examples out there. But what would you say are some of the additional golden threads of success that run through all of these businesses, and the decisions that these CEOs made that are covered in Fabric of Success?
So, keeping on the same theme, but forget about employees, and let's look about the person at the top, the person kind of steering the ship. I think a lot of people who invest go about it in entirely the wrong way. So what I mean by that is that a lot of people jump into investing driven by an objective to make money. Now, chasing wealth is completely the wrong way to go about it because it leads to poor decisions. Making money isn't the objective, it's the consequence of doing things right. And so essentially, what I've found is that being a good investor is largely about investing in the person rather than the idea. So, what do I mean by that? Well, we've just spoken about Apple, and so we can kind of use that as an example, but I'll draw some others out as well. So, Apple has always been the same company, or are targeting the same addressable market with the same with the same kind of product base. It was set up originally by Steve Jobs. They brought in John Scully, who came from PepsiCo. Now, PepsiCo is a commoditized business. And when John Scully arrived, he was arguably completely out of his depth because, running a commoditized business is very different from running a high-tech business. And as we've already discussed, he nearly crashed the ship and it was very close to hitting the rocks. Steve Jobs came back, turned the whole thing around. So same company, same target market, same product base, but two different people ended up in very different places. Scully nearly crashed the company. Steve Jobs made it one of the most successful companies on the planet. Think about Sam Walton. So Sam Walton, as you probably know, was the mastermind behind Walmart, one of the most successful grocers ever. Now, he set up his first store in Newport, Arkansas. But one of the mistakes he makes, and it comes through in his biography, Made in America, is that the lease agreement he had on his first store didn't have a renewal clause, and it was one of his biggest regrets in his career. Now, he set up this store and it ran for 5 years or so, and it was the most successful grocery store in the state in terms of revenue, in terms of customer base. It was so successful, it was incredible. This was the first store. This is before it became a chain. Now, because there was no renewal clause in his lease, his landlord saw how successful the store was. He was very greedy, and he decided he wasn't going to renew the lease. Instead, he was going to take over the store. So he took over the store that was already set up by Sam. It already had the client base. It already had the reputation. It already had the revenues. And the landlord gave it to his son to run. What happened to that store? Kind of crashed and burned. Sam Walton was knocked down. He had this business he'd invested all of his time and passion into. It was stolen from him, for want of a better word, and so he went away and he set up a store somewhere else, and that became successful. And then he set up a second, a third, a fourth. By the time he got to his 8th store, he went back to Newport, Arkansas, and he set up this store. The one that had been taken from him by the landlord already had a 10-year head start on him. And still, his new store came and stole a march on that business. And of course, he then grew Walmart into one of the greatest grocers on the planet. Again, same business, different person, completely different result. And these things happen again and again. Herb Kelleher at Southwest Airlines. We're all familiar with Warren Buffett's criticisms of the airline industry. It's destroyed more capital in the course of its existence than it's ever created. So many airlines have gone to the wall, they've collapsed, and airlines typically fluctuate between profitability and loss from one year to the next. Now, Southwest Airlines stands as an exception. It had 40 years of uninterrupted profit. And that profit was only interrupted by the COVID pandemic, when effectively the world shut down and airlines weren't flying anymore. So that was completely beyond his control. But how does a commoditized industry, a commoditized product, flying people from one city to the next, without any particular loyalty, brand loyalty, managed to become so profitable when every other competitor is struggling? Again, it was the person at the top. It was Herb Kelleher and the way he ran the business. And so, these are kind of the golden threads that I'm picking out. And one of the things, I'd like to highlight to people who are in the investment community or people who are looking at getting into investing for the first time is the person makes all the difference. So, I can expand further on this, but I think I've given you quite a long answer already.
No, that was.
Are you happy for me to continue?
Yeah, please. That was fantastic. Look, you're on a MicroCap podcast. I mean, you're preaching to the choir when you say that it's all about the person in management that's at the helm. right? And
Yeah,
just in general, and it's about the people in general, of course, but also, that one singular person that is, essentially running the company too. So yeah,
but
keep going.
people don't always get it. I always read an
Totally.
investment thesis or investment analysis, even put out by the pros, and they're always focusing on the numbers. And they're looking at discounted cash flows, and they're looking at projections, and there's very little, if any, focus on the pedigree of the CEO. And it's the guy at the top that's going to make all the difference. And if you've ever read the Creativity Inc. book, which is the Ed Catmull of Pixar biography, he kind of hits this on the head. So he says ideas come from people. Therefore, the people are more important than the ideas. He says that getting the team right is the necessary precursor to getting the ideas right. And then he kind of goes on, and what he says is, it always makes me chuckle. He says, giving a good idea to a mediocre team is like giving a bottle of champagne to a child. It won't understand what to do with it. But he says, if you give a mediocre idea to a brilliant team, they'll either fix it or throw it away and come up with something better. And it is so true. And that's why I think when you're investing, particularly in small caps, it's so important to understand who the person is in the driving seat, because they're going to make all the difference. So let me give you a kind of a historic example. So I don't know whether you're familiar with Xerox PARC. That's PARC spelled PARC. It stands for Palo Alto Research Center. So it was established by the Xerox Corporation back in the...
I am. Yep. Sorry.
Yeah. So Xerox PARC was established by Xerox Corporation, for anybody that doesn't know, back in the 70s. And it was responsible for pioneering many groundbreaking computer technologies. So just to give you an idea, it developed the GUI, the graphical user interface. It developed the computer mouse. It developed Ethernet networking, laser printing. And it actually developed the first ever personal computer, something called the Alto. But critical here is that although Xerox PARC had all of the ideas, and it also had some brilliant people who developed these things, it failed to capitalize on many of its inventions. So it had the ideas, but it didn't know what to do with them, which goes back to Ed Catmull's quote, giving a good idea to a mediocre team is like giving a bottle of champagne to a child. So, critical here, if you focus on the GUI, the graphical user interface, which Xerox PARC developed, it didn't commercialize it, but Steve Jobs was inspired by it. This was really early. So, I know you're focused on small caps and you're thinking, well, why am I talking about Steve Jobs? Because Steve Jobs is Apple, and Apple are one of the biggest companies on the planet. But we're going back now to the end of the 70s, beginning of the 80s. It was a small cap back then.
Yep.
If you wanted to invest in Apple back then, it was all about Steve Jobs. You had to recognize the talent of this particular guy. So he was inspired by the work that was being done at Xerox PARC, and he developed the first commercial GUI for Apple in a computer that was called Lisa. It was after a child that it had with I think a school sweetheart of his. So he named the computer after this child, Lisa, and they incorporated the GUI. This was about 1980. Up until that point, computers were working off command line DOS operating systems, and this was the world's first graphical interface. So it was a major leap forward. Now, Bill Gates came along, and he obviously had Microsoft, and he saw what Apple were doing, and he thought, well, this is wonderful. This is the way forward. We need to copy what Apple are doing, and so he launched the first Microsoft GUI, which was called Windows 1.0. But this was significantly later. This was 1985. Now, as I said, despite their size today, both Microsoft and Apple were small caps back then. So Apple IPO'd in 1980 with the objective of raising just $100 million. So that gives you an idea how small they were. Microsoft didn't IPO until 6 years later, 1986, at which point its market cap was 700 million. So, rewind to 1980, it was significantly smaller than that. These were certainly small caps. So the interesting thing here is that Xerox failed to commercialize their GUI, both Bill Gates and Steve Jobs recognized the value of a GUI, and they both developed their own. But they both took a very different path going forward. So, Steve Jobs was very much focused on hardware development. And so he decided that he would effectively only operate or offer his GUI on Apple products because, he wanted to push the product. So if people wanted the GUI, they'd have to buy the product. Now, we know that Bill Gates took a very different approach. He wasn't focused on hardware, he was focused on software. And he made the Microsoft operating system, Windows, available to everybody on any machine. And that really opened the floodgates. And by 1994, he'd gained 90% market share. And the really interesting thing here is that, he didn't introduce his GUI until 5 or 6 years after Apple had developed theirs. And, had Steve Jobs decided to go down the software path instead of the hardware path, the chances are he would have owned the software market. We wouldn't have Windows. Microsoft would have been too late to the party, and it could be, Microsoft would have faded into nothing, and Bill Gates would have been a developer for someone else. So it's very interesting how these decisions push down different paths. But essentially, it kind of goes back to what I was saying earlier. Xerox developed the GUI; they did nothing with it; they didn't commercialize it. Both Bill Gates and Steve Jobs recognized the value in it. They both took different paths, and both of their companies are now worth trillions of dollars. And so it's all about the person.
I just want to be like one of those people just saying preach, but I couldn't agree more with that statement.
Yeah.
Having interviewed tens of thousands of CEOs, at least thousands for sure, but maybe even tens of thousands at this point, I can almost without a question, 100% agree with everything.
Well, listen, Warren Buffett agrees with this as well. I've got a quote from him.
Now, who am I to agree? Buffett agrees with it. That's all we need to.
Exactly. No, I've got a quote from him. He says the single most important decision for him in evaluating a business is the management. He says he looks for people with talent, with character, and with a high degree of integrity. And he says if you have those three things, you've got a tremendous business.
And look, at the end of the day, too, like I don't want anybody listening to this who's like, look, I'm more of a quant. I don't focus specifically on that. Like I get it. I respect it. And if you're making money, by all means, but I'd say for the most part, I think most would agree that if you want to be a successful investor in general, but especially in small, micro, and nano, where you have access to management team more often than not, it really comes down to management, especially for a lot of these companies where it's, it's a one product, one service company where it's all about that CEO, if they can, right the ship or keep going, all that kind of stuff.
Listen, don't get me wrong. I use spreadsheets. I run models. I build models.
Of course, you gotta do that too.
But the point I'm making is that they should never be the starting point. For me, I've always got to look at the qualitative aspects of a business, in particular who's running it, and the direction of travel, and what they believe and their approach to business. And through my book, The Golden Threads, I now have this template in my mind of what these golden threads look like that run through successful companies. And if I spot a company that's displaying these golden threads at a young age, at that point I'll start to analyze the numbers. But I'll never put the numbers first, because that's almost like putting the cart before the horse.
100%. So speaking to going back to the book and some of the golden threads that you highlight throughout the book, were there any surprises that once you did your research and dug into the successful CEOs, what made them successful, what made their companies successful? They're like, oh, that's interesting. Like that, I never expected that to be something that all of these CEOs had in common or did in common. So love to hear your thoughts there.
Yeah, well, you know what? You've got all these different threads. And as I said, the book focuses thematically on the various aspects of running a public company. But all of these things fit together. And by the time you get to the end of the book, you realize that they are inextricably linked. So, let me give you an example. Decentralization is a key theme that you find in a lot of successful companies. So, a lot of successful CEOs understand that they can't micromanage every part of the business. And as the business grows, there's a danger that it could become a bureaucratic beast weighed down in process. And the only way to defeat that is to decentralize, to effectively break the business down into little components and to delegate responsibility and authority to other people in the business, trust them effectively. Now that theme goes back to recruitment. So if you look at very successful businesses like Enterprise, the rent-a-car business, fantastic company. Your Costco is another great example. What these businesses do is they recruit people who they believe can start at the bottom but work their way all the way to the top. Now that takes a completely different mindset. If you're taking, if you've got a rental car business, anybody can set up a rental car business. It's not super complex. But if you've got people who are renting cars who are only ever capable of, signing paperwork and giving the keys over, that's a certain type of person. But if you're employing people who you think, okay, one day I think this guy is capable of working his way up to run the business, then you've got a different caliber of person at ground level as well, which helps you build. And if you've got that kind of person at ground level, then you can promote them with confidence. And that allows you to decentralize, because you can kind of break your business as it grows into different components, and you can trust these people because they've got the competence that you need to run those various parts of the business. And so these things are all inextricably linked.
Absolutely. I mean, what I find interesting about, again, I haven't read the book, but from what I'm gathering from it, what I'm finding most interesting about it is that this is like, it's like you're exploring from like the inside guts out, right? That's what it really feels like, is the inside guts of all these businesses, and then what you can extrapolate from that, and then see, or whose guts look the same. No, I'm just kidding. But
Yeah, no, if you think about Costco for an example,
right? Okay.
So Costco's been running about 50 years. I think it's only ever had 3, maybe 4 CEOs. So Jim Sinegal, who started Costco, began working with Sol Price at FedMart, and he started his career as a bag packer on the cash till. And he worked his way from packing bags, packing the shoppers' groceries, customers' groceries, all the way up to running the business and effectively establishing Costco. And even more recently, Jelnik started his career at Costco as a forklift truck driver. But again, they look at recruiting people who have the ability to start at the bottom and work their way up. And I don't have to tell you how phenomenal Costco is as a business. So it works. That works. And drawing that theme to a completely different type of industry, Constellation Software. I don't know if you're familiar with Constellation. It's run by Mark Leonard. Fabulously successful business. And what Mark does is he invests in vertically integrated software businesses, and effectively brings them together. He's made, I think, over 600 acquisitions, and he grew $25 million of seed capital into a business that's now valued at, I think, over 60 billion. But essentially what he said is that his track record, what he's learned is his track record of recruiting people from outside is that it's a dangerous game. You're effectively rolling the dice. It only works 50% of the time. A lot of the people you take on from outside, they don't work out. You have to get rid of them. You have to train new people up. For him, it made so much more sense to recruit people internally, to promote from within, which goes back to exactly the same thing that Enterprise are doing and exactly the same thing that Costco are doing. And so now Mark Leonard doesn't recruit externally anymore. He'll only recruit from within. And at the ground level, he brings in competent people. So again, these are golden threads. You see completely different businesses, different industries, different countries, but they've all converged on the same conclusion. That this is the best way to go.
So James, we're coming to the close here, and I've read quite a few business finance books over the years, and I'm always trying to glean anything I can from these books. When you were writing the book and then ultimately finished it, rereading it and thinking about it, what lessons did you take from this one, exercise onto itself, and then potentially what you want others who are going to consume the book. What did you take from it, and how did that help with your investing process philosophy? Maybe it changed it, and maybe what do you want others to also be able to take away from this in order to help them on their investing journey?
Okay, well, the key thing is that, as I said, patterns emerge. So as you're reading through the biographies and you've only got to look at Jeff Bezos' shareholder letter back from '97, which was his first ever shareholder letter, which he still attaches to each subsequent shareholder letter they publish each year. And if you read through that, this '97 was the year Amazon had its IPO. But if you look at that letter, you can see these golden threads running through. For instance, he says in that letter, we are focused on the long term. All of our decisions are going to be made with a long-term perspective. We're not interested in short-term objectives of Wall Street. And if we have to choose between, short-term wins, an EPS boost in a particular quarter, or sacrificing short-term profitability for a long-term payback, we'll always take the long term. And what Jeff Bezos was effectively saying, I think, in that letter is, look, if you want to invest in me, this is the way I'm going to drive the company. This is the way I'm going to steer the ship. And if you're behind me, then great. We're going to go on this journey together. But if you're not, and you don't like the way I'm doing things, and you're only going to be focused on quarterly earnings, then, perhaps this isn't the business for you to be invested in. There are lots of other companies who focus more on the short term. And, on that subject, it's all about incentives. Charlie Munger, he always said, show me the incentive and I'll show you the outcome. And it's so true. One of the key things I really pulled out is that the most successful companies have long-term CEOs, unsurprisingly. The average tenure of a CEO, incidentally, for a public company is just over 4 years. But McKinsey run some analysis, and they discovered that the most successful companies have an average tenure for a CEO of 11.2 years. So that kind of supports the thesis. The problem is when you have a short-term CEO, they need to be incentivized somehow, and their incentive payment plan is normally structured in such a way that it creates a misalignment between what they're trying to achieve and what the shareholders ultimately need. If you're a CEO and you jump from company to company every 4 years, then what possible incentive do you have to make decisions that are in the long-term interest of the company and its shareholders? You don't. So instead, they're given these long-term incentive plans whereby they've got to boost earnings per share or some other kind of meaningless metric, and as a result, they engage in what I would call accounting alchemy, for want of a better word, in order to make the figures look better than they actually are. So if you've got the time, I'd like to give you kind of a great example. So
Go.
Thomas Watson, you're probably familiar with that name. He was the brains behind IBM. And interestingly, he started his career for National Cash Register, which was a company that Charlie Munger always lauded and said it was a company worth studying. It was a fantastic company. They effectively introduced cash registers, but they ran into problems for antitrust issues. Thomas Watson was one of their senior guys, and after the antitrust suit by the Department of Justice, the company disbanded, and Thomas Watson then joined a different company which he led and kind of turned into IBM. And over the course of the next 100 years or so, Thomas Watson and Thomas Watson's son built IBM into one of the most formidable companies on the planet. Now, the really interesting thing here is that Lou Gerstner was appointed CEO of IBM in 1993. And this kind of goes back, this is where I say all these things are inextricably linked. It goes back to people. The Watsons were fantastically ambitious. They knew exactly how to drive the company. They knew exactly what decisions to make, how to allocate capital. And IBM went from effectively nothing. It was a company that was initially called the Computing, Tabulating and Recording Company, believe it or not. A real mouthful. It went from nothing into this mammoth business. Now all of a sudden Lou Gerstner comes along, and they'd hired him in '93 from RJR Nabisco, which, as you know, is a biscuit company. Now this is a parallel really with John Scully landing at Apple from PepsiCo. What does a guy that understands the biscuit business know about IBM, which was a tech company? He didn't know very much, and he was given an incentive package which was all based around short-term metrics. So under Lou Gerstner, the really interesting part here, incidentally, is that people still hold Lou Gerstner out as a champion of industry, someone to be emulated. I personally take a completely different view. Under him, at IBM, debt ballooned from 10 billion to 29 billion. So the balance sheet was impaired significantly. The really interesting thing is nearly every dollar of the debt that he took on was allocated to share repurchases to try and push up the share price, because his remuneration was linked to the share price. There was very little investment going into the underlying business. So he was jeopardizing the long-term prospects of the business in order to prop up the share price in the short term. The earnings per share clearly grew faster than dollar profits were growing, because the share count was reducing. So it gave the impression on the face of it, for anybody looking at per share metrics, which I think is a mistake, that the business was doing far better than was actually the case. Return on equity increased, not because the earnings were improving, but because the shareholder equity, the denominator, was being destroyed by overpriced share repurchases. You'll remember that Warren Buffett will only embark on repurchases if the intrinsic value of the share is higher than the market is currently pricing the share. So he'll introduce flexibility into his repurchases. Lou Gerstner did nothing of the kind. He would repurchase at any price just to reduce the share count in order to boost the short-term metrics of the business. The problem there is, if you're using a dollar of capital to buy less than a dollar of value, you're eroding the net asset value of the company, you're eroding shareholder equity. So return on equity was improving, but not because the returns were improving, it was because equity was being eroded. So what he also did was he embarked on the sale of core assets. So he sold the global data delivery network to AT&T. He sold the printer division of IBM to Lexmark. ThinkPad. Do you remember the ThinkPad PC brand? He sold that to Lenovo in China. IBM software assets, which included Lotus Notes and Domino, they were sold to HCL Technologies. So he was effectively asset stripping the business. But of course, in the short term, all this cash was coming in, cash flows looked fantastic. So it provided short-term financial boost at the expense of the long-term prospects of IBM. Gerstner didn't care, because he wasn't going to be there for that long. And his incentive scheme encouraged him to think short term. So he qualified for huge bonuses. He left IBM with 630 million of personal wealth that had accumulated as CEO through bonuses. But he kind of destroyed that business. And it wasn't until he left that the shareholders realized. It wasn't until he'd retired a hero, and the media and all of the analysts, they kind of lauded him, because during the course of his tenure, the share price was up, but it was pushed up artificially by these short-term metrics and fear of missing out. So investors who didn't dig into the fundamentals saw the share price jumping and jumping and jumping, and they thought, well, we need to get into this. It's not too dissimilar to what happened to Tesla during the kind of COVID lockdown period. Its valuation got way ahead of the valuation of the business, and people jumped in. They didn't want to miss out, and that pushed it still higher. And this happened with IBM. But of course, when he left, the market capitalization of IBM, Lou Gerstner left in 2003. The market cap was 208 billion back then. And within a short time of him leaving, everybody realized it had been asset stripped, and everything was window dressing as far as the metrics that it had been presenting. The market cap collapsed from 208 billion down to 98 billion. This was in 2003. Now, today, 2 decades later, the market cap is still only 128 billion. So it's still half of where it was, during the time that he was there. And it didn't collapse because he left because he was great and there was nobody else to run the business well. It collapsed because he had pretty much stripped the blood from a business that Thomas Watson had taken 100 years to build. And so, these are the things that I've kind of learned. I just want to leave you with kind of an interesting story. I don't know if you're familiar with Anthony Deedon. He's kind of a reclusive investor who lives in Switzerland.
He's about to do a virtual chat with Ian Castle in about a month.
Indeed, yes,
Yeah,
he is.
looking
He
forward to
doesn't
that.
give interviews very often.
No.
But the last one that he gave, it lasted about 2.5 hours. It was fantastic. I would commend it to anybody. But he gives this little anecdote about an Arab date farmer, the date fruit, and he invested in this business. He went to visit this Arab date farmer, and this date farmer was it was family business. It had been running for generations, and he was enthusiastically planting new date trees in the orchard. And Anthony Deedon said to him, how long will it be before these date trees grow and produce commercial quality fruit? And the date farmer said they're not going to produce commercial quality fruit for another 40 years, which wasn't in the farmer's lifetime. The farmer would almost certainly be gone by then. But he was enthusiastically planting these trees. And Anthony Deedon was quite taken back by this. And he asked the farmer, why he was so enthusiastic about planting trees that he would see no benefit from. And he said to him that, this is not about personal enrichment. It's about as I inherited an asset, and my job is to manage that asset as best I can, and to then hand it down to the next generation in better shape than I inherited it. He said, I'm grateful for the generations that came before me that planted those trees that we're now harvesting. Had they never done it, the farm wouldn't be as successful as it is today. And I'm hoping that, 40 years time, long after I'm gone, the farm will be, just still more successful. Now, of course, the farmer, instead of planting these trees and investing capital into trees that wouldn't yield fruit for 40 years, he could have stripped that capital. He could have put it in his pocket. He could have lived a very comfortable life, but he didn't do that. And I think that really separates a great CEO, a great owner of a business with the average. I think 90% of CEOs who are more interested in personal enrichment. One of the things I look at when I'm analyzing businesses is stock-based compensation. It's one of the most abused aspects of corporate finance today. I cover it in a lot of detail in one of the chapters of the book, so I won't delve any deeper here. But effectively, stock-based compensation started with a legitimate objective. Effectively, if you're setting up a company from scratch, a small cap business, you're a founder of a business, you don't have the cash flow necessarily to recruit the right people. So in lieu of cash, you give them a share of the business. You say, you help me make it successful, you're going to benefit alongside me. Perfectly legitimate. So it's in lieu of cash, it's instead of cash. But what you're seeing today in companies like Apple and some of the big tech companies is that they're sitting on huge piles of cash. They're hugely cash generative. They pay enormous salaries to their key personnel, and the stock-based compensation is on top of that. It's completely unnecessary. It wasn't what stock-based compensation was designed for, and in essence, it's tantamount to a transfer of wealth from shareholders into the pockets of insiders. And I'll just leave you with a little tale of woe on that point, just to really hammer that point home. Twitter IPO'd in 2013, and it sold, it went private, as you know, when Elon Musk acquired it 10 years later. And he acquired it at pretty much the same share price that it IPO'd at. Now, inflation adjusted, that amounts effectively to a negative total shareholder return over a decade. So it was a really painful period for shareholders. Twitter never paid dividends. So the shareholders never received any kind of income from their shareholding. Meanwhile, it paid enormous amounts of stock-based compensation. And Jack Dorsey, the CEO of Twitter, over that 10-year period, took his personal wealth from 0 to 4.5 billion. So there's the case study for you. Shareholders had a negative return and he became incredibly wealthy. Stock-based compensation is a bad thing. And I delve into it in more detail. It's certainly corrupted the markets as well. It's created bubbles in the market. I won't explain that in more detail because it's quite complicated. But again, I delve into it in the book. But one of the first things I look at when I'm analyzing any business is stock-based comp, because if there's an abuse of stock-based compensation, then I don't really want to be invested in that business, because it's effectively a tax being levied against shareholders by the insiders. There's no alignment. Insiders will tell you stock-based compensation creates alignment. It's a myth. It's not true. And again, in the book, I go into a lot more detail on that. So yeah, let me kind of pause there and come up for breath.
No, I mean, look, you just covered so much, and as much as I want to keep going and down some of these rabbit holes, I'll have to have you come back on again, and we'll do it because we are there. So yeah, let's see the front cover. Quick pause for the front.
You see that?
Yeah, there it is.
Okay, so that's the book, Fabric of Success, the golden threads running through the tapestry of every great business.
Let's get that blur off so I can. There it is. Okay. Fabric of Success. Very cool. If you're watching on YouTube, you'll be able to see the front cover. I'm going to put a link in the show notes so that you can go and get it on Amazon. So, James, with that, where can our audience go and find more information on your fund? And of course, I'm going to put the link to the book on Amazon.
Perfect. Wonderful. Thank you very much.
Absolutely. So wait, for the fund, it's what is it? It's just theinvestment.company, right?
Yes, it is. It is. But the investment, so the fund is a private. It's almost like a kind of a family fund. Sure. So almost like a family office thing. So it's family and friends. It's not generally open to the public.
I know. So people can find more about you.
But you can find it. So yeah, exactly.
Very cool. Yeah. All right. Well, James, thank you so much for joining me. Really do appreciate it. Good luck. Stay safe. And I look forward to speaking with you again soon.
Excellent. Thanks for having me.
And for full disclosure, James does own Apple.